We were making a video about possible Fed moves and how they might affect gold price, but it took long enough that the possible moves became actual moves, so I guess all we really have left is the good part. So today's conversation is with Lior Gantz. He's been on the channel quite a few times actually. He's the president of Wealth Research Group, and we're going to start off with the simple questions like why are central banks stocking up on gold, or what's the near-term outlook for price? The simple questions though, they kind of lead to the bigger ones, so I just kind of let it go. Now, there are two hard edits in this one. First, at the beginning, because Lior said he expected all of the things that Jerome Powell just said. No need to go over that. But we did record this prior to the Fed meeting. We're going to cut right into what Lior thinks all of that means. And then there's a second, mostly unrelated conversation at the end. It's about BRICS and G20 shenanigans. I cut that one out because this one went long. We have plenty in this one here, though, so let's just get into it. All right, Lior, good to see you. How are you?
I'm good. How you doing?
I'm great. I think we start off here with the general stuff. So, general questions first. Maybe what you see as the price movers for gold and silver in the near term. And I know that's a broad topic, so maybe we look at a few different time frames, like 2024 with the possible Fed rate reversal. Then there's this idea that there's possibility of a Goldilocks situation. I think we talked about that yesterday and maybe got an eye roll out of it. But if we do see some
Eh,
kind of economic rebound, what does that do to gold? And then further down the road a little bit, it's probably that geopolitical mess, the idea of the diminishing dominance of the dollar, and then what all that means for gold price action. So you can start wherever you want. I think maybe if you just tell us what really is in your mind for what's going to impact metal prices.
okay. So first, let's talk about the dollar a little bit and what's going on with dollar supremacy and hegemony around the world. So, as you well understand it, between the 1990s and 2010s, the United States was the only superpower, undoubtedly, in the world. But it abused its power and went on these fishing expeditions in the Middle East where they just didn't pan out. Um, and I'm reminded of the of one of the Nigerian prime ministers that came on, Walter Cronkite, I believe, was like in the 70s or 80s, and Cronkite told him that Nigeria is the most corrupt country in the world, and the Nigerian president was remarking back that the U.S. has no right to judge any other country for its current affairs because the way that the United States was formed with everything that happened with Native Americans and then with the atomic bomb and intervention in other countries. And it was a very nice debate between them. And this is to say that the United States has reached a level of some hatred in other countries that is not enough to change their policy, obviously, because otherwise you would see a lot more lashback. But certainly there's a lot of frustration in what we call the global south and the emerging markets with the way that the United States overuses and overreaches with the fact that it's so dominant and takes advantage of the fact that it has the number one economy, the number one military, and so forth. So there is a growing concern that there is an overreach, and that will have implications. So we are seeing central bankers buying gold, um, and I think that another thing we're seeing a lot of is Japan, which is the largest holder of treasuries, and China, the second largest, continuing to sell treasuries. The reason they continue to sell treasuries is because when you hold a bond, unless you hold it to maturity, if interest rates are rising, then obviously selling it now and buying later at higher interest rates is a good deal. But I don't think that that is why they're doing that. I think they're doing that because the model that we were on, where China needed a lot of dollars for this export account with the United States under globalization, has largely ended. We're exiting globalization, and for Japan, I could say the same thing. Their economic structure doesn't require them to hold so much dollars. And that means that whoever is going to buy treasuries will have to be mostly domestic. So US debt, the 33 trillion, is already held. About 25 trillion of it is held by United States entities. So, but whether it be pension funds, universities, insurance companies, actually the government holds U.S. debt. So the Department of Defense has an investment account, et cetera, et cetera. And that tells you that the model that the United States debt is moving towards is like that of Japan, where the public owns their public owns most of the debt. And that is concerning a little bit because that has created a situation where their economy has basically stalled for 30 years. So that's one thing that's really important to understand about the dollar. The dollar was so important because of globalization. And if we're transitioning to deglobalization, countries have far less incentive and far less need to hold the US dollar. So US dollar weakness in the new deglobalized world, I would say that's a big deal. Secondly, is the unwillingness of US politicians to either raise taxes or cut spending, which means that the effect of higher interest rates just means that you have on the same amount of debt that you could have raised a few years ago, you need to pay a lot more interest. Interest payments in the United States are now about 2% of GDP. That's a lot. The debt to GDP ratio is about 98%. That's a lot. There's only 14 countries with higher debt to GDP ratios. And we're moving fast into a world where you have about $1 trillion a year in interest payments. So the interest on the debt is also concerning. Not the debt itself so much as the interest on the debt component, because that's money that's going to waste. So I think that's second. Now, third, I want to talk about two schools of thought within the central banks. So one school of thought within the Fed says that inflation is too high and that we still need to raise rates. A second growing camp inside the Fed says, yes, inflation is too high, but because shelter is about 40% of CPI, and when we forward look rents, they're actually starting to deflate. In other words, new rent leases are falling. Then I don't think we should raise rates anymore. In fact, we should start to think about cutting. And that divergence, or these two schools of thought, I think those in the immediate term will determine the price of gold more than anything else. Gold and silver rise mostly on what we call inflation-adjusted interest rates. So interest rates when you discount inflation. And if you continue to raise interest rates and the CPI is remaining either stable or declining, you're creating an environment where it's just not advantageous for big players to buy gold.
Okay, a couple things there. One, with the September 20th meeting, I think it's CME Fed Watch gives that like a 5% chance of a rate hike. It's pretty much everybody assumes that there won't be one. It's mostly about what he says. Does the Fed Watch tool, I should know this, but I don't. Does it give us an estimation on when traders think that the rates are going to reverse?
Yes. So the Fed Watch tool normally shows you about 2 years forward. So currently it shows you until December 2024. Originally, the Fed Watch and the Fed Watch tool is not precise at all. So it shows you the current state of events. So as a stacker, I would say it's less of an important thing. But if you're looking to capitalize on either silver or gold ETFs, silver or gold stocks, or anything that has to do with more of a time component that's less than your the remainder of your adult life, then yeah, it has importance. Originally, it showed a cut in January 2024. Then it moved to March, then to May. Now, the first cut is projected for June 2024. With that being an election year, it's also important to keep in mind that the Fed will not do anything drastic just around the election. So if it's already at June 2024, I think that if inflation continues to be high, and you saw what happened this morning with wholesale prices, they came in hotter than expected. CPI came hotter than expected. PCE is still very hot. The ECB just raised rates in Europe. So I would say that we might be in a point where they don't cut rates until after the elections.
Do you mean that you think that the Fed is going to lighten up sooner or lighten up? Yeah,
I
okay.
do. I
Yeah,
do.
and you think it's possible that this September, I think that the meeting is 19th and 20th, so in a week or so, we start hearing from Powell. Maybe he's putting the story together.
Either in the November or December meeting, there will be acknowledgement that some data shows that the United States is kind of moving into a zero growth environment, and that there's a lot of distress, and um, and because there's encouraging stats from shelter and housing, we're starting to feel like we're on pace, something encouraging about inflation. And then I think that we shall see what they do in 2024. So they have a lot on their hands.
Sure.
This is when this becomes hard to bridge between competing interests.
Yeah, okay, all that makes sense. And seeing what happened to the gold price today, anytime, I mean, we know this by now, anytime it seems like there's a possibility that the rates are going to go up again, gold price drops down. The opposite's true if it looks like there's an actual pause coming, or this reversal, which is far enough down the road. I don't even think that plays in. But when the talk goes dovish, then prices go up.
Yes, or like you said, if the Fed, if inflation comes in hotter than expected, but nothing happens to yields expectations. In other words, the market says, hey, no matter what happens here with inflation, we still are not pricing in any further rate hikes.
Yeah.
That literally is your best signal that the market thinks that yields have peaked. Because if it doesn't do what you think it will do, it obviously means that most bond traders are saying that that is the extent of where the Fed is willing to take this. So and by the way, not a lot of people are saying it, but I did author 2 reports on this. So if you want to check those out about the soft recession and how the Fed might act, and then when gold can break out, these are new reports that I just authored for your interview. Go to wealthresearchgroup.com/recession/breakout in one word, and /market. I think those 3, each of them are a 5 or 6 minute read, are going to be very informational. They include a lot of charts and graphs about the pros and cons of each of these scenarios.
Okay, fantastic. Okay, let's switch gears. You mentioned earlier you kind of started with the longer term, and we ended there with the shorter term. You mentioned other countries having less incentive to hold the US dollar. I would say the incentive is the stability of the dollar, which is pretty hard to get with anything else. What's the alternative in your mind?
It's not that there's much of an alternative, even though right now countries have figured out a lot of sophisticated ways of hedging using either the euro. There's a lot more transactions happening that are in yuan and in the currencies of the global south. So let's say Brazil. But I would say those are starting out. That's not something that's broad. What is happening is that because of de-globalization, the foreign countries that had to hold a lot of dollars because of the way their economies operated as export economies, predominantly the Japanese and the Chinese, that model is deteriorating, and basically it's no longer valid. China is moving away from being the manufacturer for the rest of the world. In fact, it's just not that anymore. You can just call it as it is. most of the important manufacturing is moving out of China, to a large degree to the 50 countries that produce cheaper than China, but also because China is so expensive because of their regulations and other restraints that they're putting on businesses, especially on foreign businesses, and all of the paperwork and otherwise bureaucracy that they put in front of you. Today, because of shipping and freight costs and whatnot, it's even cheaper to produce some things in-house. In other words, in North America, either in the United States, Canada, or in Mexico, which is becoming a very important trading partner and manufacturing hub for the United States because it's so close and has a lot of population. You can train them. The need to hold dollars for China is not nearly as important as in the 1980s to the 2010s. So I think you'll see them continuing to reduce it. They just don't need it. They have a lot of other considerations that are far more important.
Okay, so where does the central bank gold buying factor into all this? Is that another, the asset on the balance sheet? What's the reason for it?
Well, reason number one is that if you're moving to a deglobalized world, there is a lot in the economic history of either the 19th and 20th century about the fact that a lot of countries use as part of their negotiations, they use restraints and restrictions on other countries' currencies. So as a form of currency war, they simply choose to not accept some forms of currency. And on the flip side, countries that have dominant currencies choose who they want to transact with. So you may end up in a world where countries have either a shortage of dollars or a surplus of dollars that they can get rid of, because other countries will tell them, no, if you do business with us, we rather have gold as a form of currency. So a lot of countries are shoring up their gold reserves for that type of scenario. There's just a lot of distrust between camps. As you are well aware, there's one camp that's, I would say, NATO plus Japan, Australia, and to a degree South Korea. And there's another camp that is essentially the frustrated countries. So that will be China, Russia, the global South, so Latin American countries, some African countries that side way more with the Chinese. And in the middle, you have this key country called India that, and to a degree Turkey, that are, they have so much advantages to offer to both sides that they don't need to actually choose one. So in that scenario, you may end up breaking the world into two blocks, where one block mostly transacts in dollars and euros, and the other block transacts in other forms of currencies with some intermediary between them. This is not imminent or anything, but if you want to start buying gold, you have to do it. If you have a world where high interest rates are basically killing any country that wants to borrow US dollars right now.
Okay, I think that's a good place to stop for this part of the conversation. So let's get an official sign off. Lior, thanks again for coming on. Always appreciate it.
Thank you, sir.
So there was a little bit of a hard edit there. I took some out. They always get long. But the last part that we talked about didn't really track with the rest of the conversation. We'll come back to that. I think what we had up to this point, though, is pretty important to the overall conversation. Now, Lior is pointing out the shift to de-globalization, how that affects trade partnerships, how that affects the broad need for US dollars, or the lack thereof. And that shift is driving more attention to gold. Now, we're going to come back to those other topics, those subtopics of BRICS, G20, but we'll call it good here for now. So let us know in the comments what you think. And then while you're there, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you'd like to see more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.